You're listening to the Travis Makes Money podcast presented by GoHighLevel.com. For a free 30-day trial of the best all-in-one digital marketing software tool on the planet, just go to GoHighLevel.com/Travis. Hey, what's going on, money makers? Welcome back to the Travis Makes Money podcast, where it's our mission to help you make more money. If you're new to the show, we release brand new conversations with unconventional money makers every single day of the week. So if you're not listening to this where you typically listen to podcasts, be sure to open up your podcast app of choice right now. Subscribe to the show, follow us there so you never miss an opportunity to make more money. And while you're there, leave us a quick rating and review, as it really does help out the show tremendously. Today on the show, we're going to be talking about how to make more money and optimize for retirement with my new friend, Steve Selengut. Steve is a 40-plus year professional investment manager, advisor, whose current adventure is coaching both individuals and other advisors in creating income independence for themselves and their clients. He's also just come out with his second book, Retirement Money Secrets. He was also private investment manager for 44 years, personally managing around 325 individual portfolios in the US and abroad. He is here today to share some of these secrets from his book and to chat a little bit about how you can make more money. So, Steve, what's up? Welcome to the show.
Thank you, Travis. That was quite the introduction.
Hey, you know what? I
Well,
do my best. That is what
I
happens
guess,
when you've done so many things.
yeah, I've been around so long. I guess the numbers of things add up over time, don't they?
That's how it works, is what I hear.
Yeah, yeah.
All right, well, let's go all the way back in time then, Steve. Tell me how you made your first dollar ever.
My first dollar ever I made, it's got to either be mowing lawns or teaching people how to water ski. I started doing
Oh,
both of those
nice.
things about the same time when I was about 12.
You started teaching people how to water ski when you were 12.
Yeah, I'd been doing it for
Wow.
a while already.
Wow. That was when I
And
started water skiing when I was 12.
Yeah. I think I started probably when I was maybe 10,
Okay.
you
Got
know.
pretty good at it pretty
My
quick then.
brother had the boat first, and then, and I skied then, and then I inherited his boat, and then, you know, then I
Nice.
used that. It's it's a long time ago.
Nice. So you
Long
were
time
always
ago.
kind of doing these
I
kind of
always
entrepreneurial things.
Yeah, I was always doing something. In fact, even the lawn mowing thing. I mean, I took in two of my closest friends. We all bought lawnmowers, and we had almost a little company going where,
Yeah.
he'd go one way, I go, we'd each have our own little few clients to work with, and then we'd, divvy it all up.
Yep.
You know.
Yep. My friends and I did the same thing when we were in high school. Is yeah, started landscaping, mowing lawns, putting in sod, and fixing sprinklers and all that good stuff.
Right, yeah.
Yeah, yeah. But it taught a lot of lessons though, even about managing money at that age.
It did, and I had something else was going on at the same time. My father was a developer, and that's really where most of my contacts for lawns came from, were from his customers. And he built houses, he insured people, he financed mortgages.
Hmm.
He had a lumber yard that once I got my driver's license, I wound up driving a truck for him.
Wow.
So he had all these streams of income going on.
Yeah.
And while I was doing these odd jobs, since he was taking care of the college funds and all the other stuff going on for me, he said, "You're going to give me 25% of what you make, and I'm going to put it away and have somebody invest it for you."
Ah,
And
nice.
he did. So I had this, I was really lucky. I mean, I had someone who was focused on income
Yeah.
his whole life, and he had me focused on income, and he put this money away from me. And when I was 25, he, pretty much threw these stock certificates. You've probably never seen a stock certificate,
No, no.
but back in the day, in 1970, for example, most people who invested in the stock market actually took possession of stock certificates
Hmm.
that evidenced their ownership. And
Yeah.
then eventually you didn't give them to brokers as readily as you did in a few years after that. But I did. I took the whole package. I gave it to a broker. I started doing business with her. Fortunately, she wasn't as interested in selling and commissions as she was in teaching this youngster how to manage this large sum of money.
Nice.
And every one of those stocks that I had, you'd are almost all of them are still around today, like from IBM to General Electric, General Motors,
Wow.
a couple healthcare companies,
There's some good calls back then.
some retailers. One of the retailers, Sears, is no longer with us, but uh, but they were all paying dividends.
Hmm.
So I always had income coming in, and she introduced me to the idea of having some income focused securities as well in your portfolio. So
Hmm.
I bought I when I took my first profit, which was on Shell Oil, Royal Dutch Shell, I bought my first municipal bond. I bought a Fort Pierce, Florida, 4% coupon muni bond. And I held it to maturity, which I would never do again. But still, the idea was I had both income purpose and growth purpose securities in my mix.
Wow. All stemming from money that you were making mowing lawns when you were a
For
teenager.
initially,
Yeah.
and I didn't go to the Ivy League school like my brother did. I had all that extra that he put into my investment program.
Gotcha. Okay. So
So,
instead of going to college, you could basically say, like, hey, dad, instead of paying for college, can you just put that money into these stocks?
well, he paid about 10 times less sending me to Gettysburg than he did would have sending me to Brown,
Fair,
where
fair.
he and my brother went, you know. So I didn't want to go there. I had different goals, or I should say, I had a lack of goals at that age.
Hmm.
You know, so I wound up and this woman Rita and I we did charts. We looked at the prices of these securities, these excellent securities over time, and how they went up and down, how they went up and down, and how they went up and down. And I said, why don't we buy them here and sell them there? You know,
Yeah.
the old buy low, sell high. It's not quite that simple.
Yeah.
You have to be in it, you know, to do it, and
It's
you
a bit
don't
of a
know where it's
fallacy. Yeah.
you don't know where it's going.
Right.
You don't know it's here. Yeah, you know that, but you don't know it's going to go there. Or, you know it's going to go there eventually, or at least downward a little, but you don't know when or any of those things. So what we did, we
Right.
set targets and we set rules,
Hmm.
you know, and we found a whole universe of securities that paid dividends. Just like a lot of people focus on dividend stocks today.
Yeah.
I was focusing on dividend stocks in 1970.
Yeah. You were just curious about how could this pay me money so I don't have to like get a job type thing, or
Well, no,
what made you focus on that?
I just liked income, and
Yeah.
and I saw
Yeah.
the way my parents lived, and you know, although he wasn't taking me on those vacations with him, you know,
It
so
sounds like dad. It
I
sounds
want
like
to do
dad did
that too.
something right, Steve.
Yeah, he didn't, you know, I was probably spoiled compared to a lot of others, but not
Yeah.
to the point where I was going to, you know, spend the rest of my day on the couch smoking cigarettes and watching TV.
Well, I was going to say there's a big difference between being given advantages and being spoiled. And
Yeah.
it sounds like you were not spoiled. It sounds like dad did a good job of making sure that you weren't. It was kind of
Yeah.
similar in my family. I did the same thing. My parents basically forced me to, from the time that I was like, from whether it was birthday money, Christmas money, whatever, from the time that I was a little kid, they made me save. I think it was right about 20, 25%, somewhere in there of every dollar that I ever made. And then they took it and they put it in mutual funds for me.
Mhm.
And my sister did the same thing. And then by the time we graduated high school, we each had about 10 to 15 grand or so in these mutual fund accounts.
Mhm.
And then they basically, my parents pooled that money together and bought a duplex for me and my sister. And so that was kind of like our, you know, quote unquote fund or whatever.
Wow. Cool.
But it was cool because it wasn't them just like gifting it to us as much as it was them teaching us that this is what you do with your money. If you save up a percentage of your income over time and put it away and don't touch it and don't look at it and don't spend it on the things that I would have spent it on as a teenager, which would have been stupid, frivolous, you know, little toys and trinkets and gadgets and everything else in between,
Mhm.
then then you can buy a duplex and you can earn income from a duplex and rent and stuff like that. So
Right.
they very similar. It was just the practice of like taking your money and putting it to work for you was a lesson that I was blessed to learn early on.
Yeah. I never did it though with the real estate. Like I could have jumped into business with him, but I
Yeah.
didn't because I didn't want to work 8 days a week, and go to planning board meetings and all that other stuff. But what I did, I started trading, and literally within 9 years, I was making 5 times my salary, and I was working on a life insurance company in Manhattan,
Wow.
and I was making that much money. I had records of the trading and the income I was generating. And
So you would talk to me about your schedule during this time, Steve. So you would day trade then. So you would trade between a certain like
I would
window.
trade, I would trade when I wasn't working.
Yeah.
When I was home, I would call my broker from Manhattan
Yeah.
and say, sell, you got a 10% profit there, sell it and do this. And I was doing all that. So I was, I was doing both things. My job was not very time consuming. The best thing about it was I traveled all over to companies all over the country from Boeing to Coors to, uh, and I was working in their pension investment department.
Hmm.
So I was learning about investments there. And I discovered that they didn't do two things that I was doing and I thought they should be doing.
Hmm. What's that?
They never took profits, and they didn't really care about cash flow. They didn't
Hmm.
really care about income generation. Their quality selection was really, really good. Their diversification rules were great. So I put that all into my process as I developed it, and I started making all this money. And when I left, I showed my stuff to two of my closest friends, and I said, I can do this for you too. And they became my first clients
Hmm.
in
Gotcha.
1979.
So this was kind of like a mini fund, essentially.
Separate accounts, no fund.
Oh, really? Okay. Got it.
Separate accounts. I managed, I never pooled any money ever with all my clients in
Okay.
my career for that 40 years. Everyone had their own separate accounts. And if you went and you looked, you'd see duplications in content, but you wouldn't see two identical portfolios in the 300 odd portfolios.
Wow. So it was very much a personalized
Very personal, very
investment
personal.
strategy.
Money comes to the market at different times.
Hmm.
You might buy the same securities, but you're buying them at different prices, and they reach quote maturity, which is their sell target.
Hmm.
I had a 10% sell target when I was doing individual securities.
Okay.
In about 2000 and around 2000, a little before the dot-com bubble, so just before 2000, I discovered closed-end funds,
Okay.
which I'm not sure if you're familiar with them or not, but
Yeah.
they're
Please explain.
closed-end funds are the oldest form of fund there is. They were developed in the early 1800s. They're trusts. They're pass-through trusts where a a company will have a manager and a board of directors and all that stuff, and they'll raise money in an IPO. And what they'll do with the money, instead of building buildings and stuff like that, they'll buy a ton of securities.
Ah, I see.
Okay. And then they manage those securities, income from all the normal sources, interest, dividends, premiums on options, whatever, and trading. And they have to, in order to keep their tax exempt status, they have to pass 95% into their shareholders.
Oh, wow. Okay.
So, two things you have to realize. I mean, their purpose is generating income, and the second thing is they're not going to grow in market value because they don't really have much to reinvest.
Interesting.
You can't build another McDonald's in the next town
Sure.
with only 5% of your income, you know? So you have to understand that these things are income focused. But the light bulb went off when you discover that closed-end funds give you the opportunity to trade bonds, mortgages, loans, liens, real estate, just as if they were stocks. Like you can go out and buy a portfolio right now, maybe 300 different municipal bonds from all over the country, yielding close to 7% without calling anybody to get quotes or any of
Yeah.
that baloney. You just buy it. It's like a stock, but if that's what it's got inside and it's paying you taxes and income, and you can trade it.
Mm.
If it goes up, you can sell it. If it goes down, you can buy it back. So when I discovered that, I said, "Oh my God, I've got this, $30 million in Ginnie Mae's corporate unit trust, preferred stocks in my client accounts. I'm going to convert all of that because it was generating maybe 4 or 5%. I'm going to convert it to these closed-end funds. I'll be able to take profits. I'll be able to trade it, and they generate about 60% more income at the same time."
Wow. So tell me, Steve, about a couple of like, can you define some of these terms for people listening who maybe are just completely green?
Oh boy. Well,
A stock versus a municipal bond versus
okay.
trading securities. Can you define what these things are?
Securities are issued by corporations and by governments. Governments use debt securities. You know, a bond. A bond is a debt security. They're borrowing money from you. Okay. Corporations use bonds as well, debt securities. They use some hybrid securities like preferred stocks, which is part debt, part equity. And then there's equities, the things everybody gets all excited about, the stocks that trade on the market. These are ownership. They're ownership tickets, basically.
Yeah.
The thing I told you before, I got those stock certificates. That's what they are,
Mm-hmm.
ownership. So when you buy Nvidia, when you buy Microsoft, you own a share of that company. Unfortunately, the most successful companies don't pay their shareholders very much. They are paying them, they feel, by growing the market value of
By
their shares,
appreciation of the
by
shares. Yeah.
appreciation. You can't spend it, you know? I only ever bought stocks that did pay a dividend. At
Mm.
least they show me the respect that I'm an owner. They're going to give me some of the money they're making compared to what their chief executives are making.
Mm.
I mean, the only thing you're really doing with these people is you're making their owners rich, and if you don't take advantage of that going up and sell it and take your profit, chances are you're going to experience a downturn. You're going to panic and you're going to sell it for less. So I always buy stocks that pay dividend. I did, and then of course I discovered that I could use closed-end funds for stocks as well.
Mm.
When after the financial crisis, they pretty much stopped going down. The high quality companies. I wouldn't in the old days. I wouldn't buy them unless they were down 20%.
Okay.
You know, but then they got to the point. The only ones that went down 20% were the ones that were in trouble, not the good ones.
Yeah.
So I had
Right.
to find something else to put my equity money in, and I converted it all to the closed-end funds because they own every one of those companies.
Mm.
You'll buy a managed fund, and it is managed of hundreds of different companies, and you're getting this extremely high rate of interest on it, regardless of where it goes in price.
Yeah. So your goal is not to participate in the equity appreciation upside potential of a company. Your goal is to participate in the distributions from profit.
The distributions and taking profits when the closed-end fund goes up in price, because like I said, it also trades like a stock.
Hmm.
So instead of having a 10% target, now where it's not a target, it's a level that I will definitely sell. I'll never let it get any higher.
Hmm.
And I set a same a cap, a profit cap, you might say, of 5% with closed-end funds because you're asking hundreds of securities to go up, you know.
Hmm. Yeah.
But
Got it.
but when the market's down, you take pretty much any profit you can get. When the market's up, you take that 5% and you just don't let it go further because you can always find something else
And this is the
to manage.
strategy that you still use now to this day is these
I use
closed-end
this,
funds.
yeah, I use this. I used to use it with stocks and bonds. Now I use it exclusively with closed-end funds. To give you an example, in 2021, And I manage I was managing just under 100 million at that time.
Okay.
But in 2021, the distribution income was over $7 million.
Oh, wow.
That's 7%.
Yeah.
The capital gains, $7 million. Seriously. So I made just as much taking the profits as they came along as we generated. And I'm saying I didn't make it. My clients made it.
Sure. Sure.
So in effect, I made them like 5 or 6 years of my fees in
Yeah.
advance, so they would never say that, I was making more money than they were for sure.
Are
But
there any barriers for somebody listening to get into these closed end funds? Like, is there any sort of accreditation required or anything like that, or can you just literally go buy?
only if you're in Europe. The
Okay.
European Union has a restriction on them. You have to be, quote, a professional.
Mm,
But
okay.
but if you have enough money, you can get that designation,
Okay.
basically. I
Got it.
don't mean in a bribe. I mean in assets. Yeah, I mean, you can buy a you can buy a portfolio of the top stocks in on the New York Stock Exchange or anywhere else, the S&P, for the average cost of the 100 closed-end funds I use. The average cost per share is $14.
Oh, wow. Okay.
So you can
So
buy 100
anybody can get
shares.
started doing something
Anybody
like
could
this.
get $1,400 to get you started with a diversified portfolio. Um, you can some of them, I can't mention any names, but some of them are as low as $6. You can
Wow.
buy,
Okay.
and I used to do that for a small. People would say they're setting out an account for their grandchild. That's what I would do. I'd put them in 10 or 12 of these smaller priced closed-end funds, and they'd have a diversified portfolio of diversified portfolios. So as
Yeah.
safe as you could possibly be, and generating a high level of income.
And now with the crazy interest rate environment that we're in, and I say crazy as relative to what it's been the last 10 to 20 years, because obviously
10
before
to
that it
20.
was
You,
much higher than
you're
it is now. But
good.
um,
I'm glad you recognize that.
yes, but
Today's high interest rates were, 2000s low interest rates,
sure, sure, yeah.
basically. Yeah.
In this environment now, are there certain asset classes that you are more excited about because they like so these muni bonds that you're talking about, these are paying much higher
Oh yeah,
returns
they're
than they
paying
were a decade, two decades ago.
6.7% on
Wow,
average. That's an average of 50 different bonds. Munis are paying that tax free.
that's
The
crazy.
my equity universe, which contains about 100 equities, closed-end funds, 10.5%.
Oh, wow.
And the fixed income, the income ones are paying about 10.8%, 10.7%
Wow.
today.
Yeah, so like I say that just to say that we talked to a lot of real estate investors and things like that on the show, and it's one of those areas that's kind of getting squeezed a little bit right now, especially commercial real estate, multifamily.
Mm,
Different funds and syndications like that are getting squeezed a little bit right now because of the interest rate environment. But that's what I try to tell people is that money doesn't vanish. It doesn't go into thin air. It doesn't just disappear. It just changes hands. And just because one sector is getting squeezed does not mean that all of them are in bad shape. It just means that you got to look around and find something else. And this seems to be like one of those areas where, especially a bond like that, like this is a pretty secure investment. You're
it
literally
is.
loaning money to the US government. Like, I don't think they're going to default on that.
Yeah. On government, well, they're state and government bonds,
Hmm.
but tax exempts are all various states because the
Yeah.
government doesn't have any tax exempt bonds
Okay.
itself. So, but still, the level of risk is very, very low on them. In my career, I've only seen one major default on a municipal bond, and that was back in the 80s.
Okay. Wow.
So,
So, in terms of investing, this is actually a very, very quote unquote safe investment. All investment is risk, of course, but
right.
this is of the things that you can invest in. These things are
Well,
relatively low risk with
it's,
now high yield.
right. It's just like, the selling point. of mutual bond or mutual funds when they first came on the scene. And the reason they became so popular because after the Great Depression, the individual investor just disappeared from the marketplace. It wasn't
Mhm.
going anywhere near it. So to bring them back, mutual funds said, you can buy a whole community of companies and you'll have the protection of if one goes bad, it's not going to kill you like it used to. So closed-end funds are operating under that same idea, but they're actually managed the same way you would manage a corporation.
Mhm.
The mutual funds are managed, yes, but you own the actual shares
Yeah.
inside. And because of that, let's say we have a dip like we had in COVID, and the market goes down 40 points. When everybody panicked and sold, the mutual fund manager had to actually sell the securities, regardless of what prices they were getting, in
Mhm.
order to pay the people the money that they wanted. And when prices are ridiculously high and your advisor says, oh, we're going to put you in all these beautiful funds that are now way up there and they're great, that guy has to buy more shares at those high prices. The manager of a closed-end fund doesn't have those restrictions because
Mhm.
you're selling your shares to other people, not to people who, have any management or interest in these securities. You don't own the securities, you own the trust.
So
So it's
I assume you go into detail about a lot of these things inside of your book, Retirement Money Secrets. Is that kind of the
right.
purpose behind the book, Steve?
Oh yeah, Retirement Money Secrets tells, and it's a conversation between me and a pretty much a newbie type investor who's getting closer to retirement.
Got it.
And it was perfect because the person I wrote the book with was in the exact same position. So she had all the right questions that somebody there would have.
Sure.
And and there's a big parallel between a young investor and an old investor. The young investor can't afford to take too much risk because you want to get that you want to get that bottom tier working. You want to get that money going before you take any risks. You don't want to, like I used to get clients back in the day when IRAs were $1,500 was all you could put into an IRA.
Hmm.
And I'd get them the second or third year and they had $500 in their IRA. I said, oh, well, when are you going to start investing the full amount? And they say, that was the full amount.
Hmm.
You know, they
Yeah.
lost it all because they took tips on, oh, what's hot, that type of stuff, instead of
Sure.
looking for the safer path in the beginning. Yeah, these things are good for both types of people.
Yeah, I
And
love that, man. I appreciate you for stepping in and writing a book like this. I mean, this is right up our listeners' alley here. This
good.
is the like I love Scott Galloway's definition of wealth. Is he basically just says wealth is well his definition of wealth is if you once you have passive income that's greater than your monthly burn, when your monthly passive income is greater than your monthly
Okay.
burn, that's what wealth is. Because there's people making $2 million a year and spending every penny of it, and there's
Right.
people that are making 50 grand a year on
Oh,
passive investments, and their total expenses for the year are $42,000. It's like, well, that person's wealthier than the person making 2 million that doesn't have any money left over.
right.
But the question becomes, like, how do you actually invest in vehicles that provide some sort of passive income? And this seems to be like one of those vehicles.
Yeah, it could be passive income if you want it to be. I prefer it to be active, and I when I this is the book, by the way.
Yeah, yeah.
When I when I run a portfolio or my own portfolios, I actively trade them,
Okay.
but that's not a requirement. There's a lot of things in the book to tell you things to avoid, a lot of quote Wall Street isms that you really shouldn't do to if you want to grow your income, because it's not just having it coming in. You want it to grow. You
Sure.
want it to grow. So the approach that I usually emphasize is how to make it grow, and back to budgeting, you don't want to spend more than 60% of the income, even when in retirement, so that you can put that back to work and make it grow so it can keep up with inflation and stuff like
Yeah, you
that.
don't want to miss out on the magic of compound interest along the way.
Compound interest, exactly. There's another definition for wealth that relates also for, there are two times that, well, you can, uh, wealth is a position when you no longer have to take any risk, any severe, significant risk. You don't have to,
Hmm.
you
Hmm.
know?
Yeah, I like that a lot.
So that's
Steve,
that's another.
thanks for doing this, man. Where can people go get a copy of your book? Is there somewhere specific you'd like them to go?
Amazon is the easiest and the
Perfect.
best place. They can get the Audible book there as well,
Great.
and it's in a, and all three varieties plus the Audible
If
are
any of
available at
this
Amazon.
conversation has intrigued you or interested you in the least, then you owe it to yourself to go pick up a copy of Steve's book, Retirement Money Secrets, which you can find over on Amazon. Steve, thank you so much for doing this. I appreciate you. Everybody else listening, tuning in. Remember, money only solves your money problems, but it's a little bit easier to solve the rest of your problems if you got some money in the bank. So let's solve that problem first here on the Travis Makes Money podcast. Thanks for tuning in. We'll catch you guys next time. Peace out.